Ever walked past a grand bank building and wondered, how exactly do these institutions make so much money? We deposit our paychecks there, we take out loans, we use their services daily. But have you ever really stopped to think about the business model of a bank? How do they actually generate profit? And more importantly, how does your financial activity contribute to their gains? It's not always obvious, and sometimes it can feel a little opaque. But understanding how banks profit is actually crucial to becoming more financially savvy yourself. Let's pull back the curtain and unveil the key ways banking institutions gain from your finances. Welcome to the video. Today, we're tackling a really fundamental question. Why do banking institutions gain from your finances? Banks are essential parts of our modern economy. They provide vital services, they safeguard our money, they facilitate transactions, they offer loans to individuals and businesses. But they're also fundamentally businesses. They exist to generate profit, just like any other company. And understanding how they generate that profit, understanding their core business model, is not about being cynical or distrustful. It's about becoming a more informed and empowered financial consumer. When you understand where banks make their money, you can make smarter choices about how you use their services. You can identify opportunities to minimize fees, to maximize the benefits you receive, and to ensure that your financial interactions are working for you as much as they are for the bank. In this video, we're going to break down the main ways banks profit from your finances. We'll look at loans, fees, investments, and some of the less obvious ways banks generate revenue. Let's get started and demystify the banking business model. Point 1. Interest on loans, the core revenue stream. The most significant way banking institutions gain from your finances, and really the bedrock of their business model, is through interest on loans. Lending money and charging interest is the oldest and arguably still the most profitable activity for banks. It's how they generate the largest portion of their revenue. Think about all the different types of loans banks offer. Mortgages for buying homes, auto loans for purchasing vehicles, personal loans for various needs, student loans for education, business loans for companies, and of course, credit cards. The basic principle is simple. When a bank lends you money, they charge you interest. Interest is essentially the cost of borrowing money. It's a percentage of the loan amount that you, the borrower, have to pay back to the bank in addition to the original loan amount, the principal. For example, if you take out a $10,000 personal loan with a 10% annual interest rate, you'll not only have to repay the original $10,000, but also interest charges over the life of the loan. That interest you pay becomes revenue for the bank. When you consider the sheer volume of loans that banks issue, millions of mortgages, auto loans, personal loans, and credit card balances across the country, you can start to see how interest income becomes a massive revenue stream for banking institutions. The higher the interest rate on a loan, and the longer the repayment period, the more profit the bank makes from that loan. This is why interest rates are such a critical factor in the banking business. Intriguing fact, did you know that the global loan market is a multi-trillion-dollar industry? It's truly a massive scale. Interest income generated from these loans is not just how banks make a profit, it's actually the lifeblood of the entire banking system. It fuels their operations, allows them to offer more services and reinvest in the economy. Loans and the interest they generate are a fundamental driver of economic activity in our modern world. Point 2. Fees, transactional service charges. Beyond interest on loans, another significant way banks gain from your finances is through a wide range of fees. These are essentially charges for various transactions, services, and account maintenance. Fees can sometimes seem small individually, but they can add up significantly over time, contributing substantially to a bank's overall revenue. Think about all the different types of fees banks commonly charge. ATM fees when you use an ATM outside of your bank's network. Overdraft fees when you spend more money than you have in your account. Monthly account maintenance fees, especially for certain types of checking or savings accounts. Wire transfer fees for sending money electronically. Late payment fees on credit cards and loans. Foreign transaction fees when you use your card abroad. And many, many others. Individually, many of these fees might seem relatively small. A few dollars for an ATM withdrawal, a monthly maintenance fee of $10 or $15. But when you consider the sheer volume of transactions that happen at banks every single day and the millions of customers paying these fees across the entire banking system, the cumulative effect is enormous. ATM fees alone generate billions of dollars in revenue for banks every year. Overdraft fees are another massive profit center. These transactional and service charges, while often perceived as minor inconveniences by individual customers, collectively form a very significant revenue stream for banking institutions. It's important to be aware of these fees, to understand what triggers them, and to take steps to minimize them in your own financial life. Intriguing fact, here's a slightly less obvious point. Bank fees are sometimes designed, consciously or unconsciously, using principles of behavioral economics. The idea is that individual fees are often set at amounts that are small enough to ignore for many customers in the moment. A $3 ATM fee might not seem like a big deal when you need cash right now. However, in aggregate, across millions of customers and transactions, these small fees become massively profitable for banks. Being aware of this, understanding how fees work and how they can accumulate, is the first step to taking control and minimizing these costs in your own financial life. Simple things like using in-network ATMs, avoiding overdrafts, and choosing accounts with minimal fees can save you a surprising amount of money over time. Point 3. Investments leveraging deposited funds. Now, let's move into a slightly more complex area of how banks gain from your finances: investments and leveraging deposited funds. You might think that banks simply hold on to the money that customers deposit, but in reality, banks actively use those deposited funds to generate further revenue through various investment activities. This is a core part of how the fractional reserve banking system works. Banks are generally required to keep only a fraction of their deposits in reserve. This is the fractional reserve part. The rest, they can lend out or invest. This is how banks leverage deposited funds to create more money and generate profit. Here's a simplified example. Imagine you deposit $100 into your bank account. The bank might be required to keep, say, $10 in reserve. The remaining $90, the bank can then lend out to someone else as a loan or invest in various financial instruments. That $90 loan then gets deposited into another account, and that bank can then lend out a portion of those funds, and so on. This process, repeated throughout the banking system, effectively multiplies the initial deposit and creates more money in the economy. This is known as the money multiplier effect. And for banks, it means they can generate revenue not just from the money they initially receive as deposits, but also from leveraging those deposits to engage in various investment activities. These investment activities can include investing in government bonds and securities, which are generally considered lower risk; trading in financial markets, buying and selling stocks, bonds, and other assets to profit from market fluctuations; investing in real estate, sometimes directly or indirectly through mortgage-backed securities; funding large-scale infrastructure projects or corporate expansions through loans and investments. Intriguing fact: it's important to understand that bank investments, while potentially profitable, also inherently carry risks. When banks make investments, there's always a chance that those investments could lose value. The stability of the entire banking system relies on banks making sound investment decisions, managing risk effectively, and maintaining adequate capital reserves to absorb potential losses. Historically, when banks have engaged in excessively risky or poorly managed investments, it has sometimes led to major financial crises with widespread economic consequences. This is why bank regulation and oversight are so crucial, to ensure that banks operate responsibly, manage risk prudently, and maintain the stability of the financial system as a whole. Point 4. Data customer insights, monetizing financial information. Finally, let's discuss a less obvious but increasingly significant way that banking institutions gain from your finances: data and customer insights. Banks, by their very nature, sit on a vast treasure trove of financial data. They collect and process enormous amounts of information about customer transactions, spending patterns, saving habits, borrowing behavior, and overall financial health. This data, when aggregated and analyzed, becomes incredibly valuable. Banks can use this data in several ways to generate further revenue and improve their business. personalized marketing and targeted offers. By analyzing your transaction history, banks can identify your spending habits and preferences and then target you with personalized marketing offers for products and services that you are more likely to be interested in: new credit cards, loans, investment products, etc. Risk assessment and credit scoring. Data from millions of customer accounts helps banks refine their risk assessment models and credit scoring algorithms, allowing them to more accurately predict creditworthiness and price loans accordingly, i.e., charge higher interest rates to riskier borrowers. Developing new products and services. By analyzing customer data, banks can identify unmet financial needs and develop new products and services to cater to those needs, further expanding their revenue streams. Selling anonymized data sometimes. In some cases, banks may also sell anonymized and aggregated customer data to third-party companies while adhering to privacy regulations. This data can be valuable for market research, trend analysis, and various other purposes. Intriguing fact: we often hear the phrase, "data is the new oil" in the digital age. And in many ways, it's true. Banks are sitting on vast, incredibly rich reserves of financial data that, when properly analyzed and utilized, becomes a tremendously valuable asset. However, this also raises important ethical considerations around data privacy, data security, and responsible data use. It's crucial that banks handle customer data ethically, transparently, and with robust security measures to protect against breaches and misuse. As financial consumers, it's also important to be aware of how our data is being used and to advocate for responsible data practices within the financial industry. Conclusion. So, there you have it. The key ways banking institutions gain from your finances, demystified. Through interest on loans, which is their primary revenue engine. Through a variety of fees for transactions and services. Through investments and leveraging the funds you deposit. And increasingly, through the value of data and customer insights they gather. Understanding these profit mechanisms is not about being anti-bank. Banks play a vital role in our economy, but it is about empowering yourself to be a more financially savvy consumer. Be mindful of loan interest rates and shop around for the best terms. Be aware of bank fees and take steps to minimize them. Understand how banks use deposited funds and consider if you are getting a fair return on your savings. And be informed and proactive about your financial data and privacy. Financial literacy is about understanding how the financial world works, and that includes understanding the business model of banking institutions. The more you know, the more empowered you become to make smart financial decisions and build a more secure and prosperous financial future for yourself. Thanks for watching. What was your biggest takeaway from this video about how banks generate profit? Share your thoughts and insights in the comments below. Let's learn from each other. And if you're committed to expanding your financial knowledge and building your financial savvy, hit that like button and subscribe to the channel. Let's build financial literacy together. Thanks for watching, and here's to becoming more informed and empowered financial consumers.